Hello everyone, my name is Nur Hazrina binti Roslan. In this assignment, I was responsible for the company background and also contribute into asset management or turnover ratios, including the fixed asset turnover and also total asset turnover. First of all, I would like to introduce Hapsen Industries Berhad or HSIB. HSIB was incorporated on 4 October 1991 and was later listed on the main board of Bursa Malaysia Securities Berhad on 2 November 2000. The company operates as an investment holding company, while its subsidiaries are involved in the manufacturing and sale of crackers, biscuits, and confectionery products. Currently, HSIB has 3 subsidiaries, namely Hapsen Perusahaan Makanan Sdn Berhad, Hapsen Hunyum Brothers Sdn Berhad, and Incommits Food Industry Sdn Berhad. The company's history dates back to 1958 when Hapsen Co. was established by 4 founding directors. The name Hapsen means success with teamwork in Chinese. As the business expanded, Hapsen Perusahaan Makanan was established in 1974 to support the company's growth and increasing the capital requirements. Over the years, Hapsen continued to grow through the establishment of additional subsidiaries and strategic acquisitions. Today, the company is recognized as one of the leading cracker manufacturers in Malaysia, with a strong presence in the food manufacturing industry. Given its long history and established market position, it is important to examine the operational challenges faced by the company and identify the suitable solutions to improve its business performance.
Hi, I am Safa Shami. My contribution in this assignment is analysis in liquidity ratio and editing video presentation. Now, I will be presenting the liquidity ratio analysis for our company over a 5-year period from 2020 to 2024. Liquidity ratio a financial metric that we use to assess the company's ability to meet its short-term obligation, meaning debt or liabilities due within 1 year using its current asset. Essentially, this analysis measures how quickly and effectively our current asset can be converted to cover our short-term liabilities, ensuring the business runs smoothly without facing financial distress. Let us begin with our first ratio, the current ratio, which compares our total current asset directly against our current liabilities. As you can see from the trend, our current ratio jumped from 1.8 times in 2020 to a peak of 2.27 times in 2023 before slightly diminishing to 2.01 times in 2024. From a strategic standpoint, what does this tell us? Because the ratio remained consistently and healthily above the benchmark of 1.0 or 2.0 times throughout all 5 years. It proved that the firm possesses more than enough liquid asset to comfortably cover its immediate debt obligation. This upward trajectory up to 2023 represents an improvement in our working capital management and reflects enhanced short-term financial stability. Next, we move to a liquidity test, the quick ratio. Unlike the current ratio, the quick ratio excludes inventory from current asset because inventory can take a significant amount of time to liquidate. This measures our ability to pay off short-term debts purely through cash and highly liquid receivables. Our quick ratio increased from 1.43 times in 2020 to 1.83 times in 2023, before a minor decrease to 1.61 times in 2024. The overall trend is highly positive since the ratio was consistently greater than 1.0 every single year. It shows that Hapsen Industries Berhad maintains an excellent liquid asset position without needing to rely on emergency inventory sales to raise cash. Even with the minor dip in 2024, our overall liquidity position remains exceptionally strong and stable. Now, cash ratio. This ratio tells us whether the company can pay off its short-term debt immediately using only cash and cash equivalents on hand. During 5 years period, our cash ratio ranged between 0.96 times and 1.29 times. It rose to 1.10 times in 2021, experienced a minor dip to 0.96 in 2022, spiked to 1.29 in 2023, and normalized at 1.05 times in 2024. The notable increase in 2023 tells us the company maintained a very high cash balance during the year, significantly enhanced our financial flexibility and security. Crucially, by staying around or above 1.0 by 2024, it indicates that our cash resources alone are completely sufficient to meet short-term obligations instantly if required. Now, net working capital to total asset ratio. Calculate by dividing net working capital by total asset. This reflects the proportion of the firm's asset financed by its working capital. Our ratio grew steadily from 0.28 in 2020 to 0.37 in 2023 before softening slightly to 0.32 in 2024. This upward movement up to 2023 signals clear improvement in our operational efficiency and internal liquidity management. It indicates that a healthy and substantial amount of the firm's total asset base is backed by working capital. Despite the minor pullback in 2024, a figure of 0.32 is still reasonably high, pointing to robust financial health and strong asset management. Finally, we look at the interval measure, which is expressed in days. This ratio determines how many days the company can continue to operate and cover its daily cash expense using only its current liquid asset, assuming no new cash inflows or additional financing come in. Our interval measure fluctuates from 192.12 days in 2020 down to 170.34 days in 2022, rebounded strongly to 182.28 days in 2023, and ended at 178.90 days in 2024. What this high interval position tells us is that Hapseng Industries Berhad has a tremendous defensive buffer. We are fully capable of sustaining regular operation for nearly 6 months even if external cash inflow temporarily dry up, while variation occur due to shift in daily working expense. The overall conclusion is clear: the company is in an excellent short-term liquidity position.
Hi, I'm Emily Gosuro. For this group assignment, I was responsible for calculating, analyzing, and interpreting the asset management and turnover ratios of Hapseng Industries Berhad for the period from 2020 to 2024. Asset management ratios are used to evaluate how efficiently a company utilizes its resources, such as inventory, receivables, fixed assets, and total assets to generate sales and revenue. These ratios are important because they help us understand the operational efficiency of the company. First, let's look at inventory management. The inventory turnover ratio increased from 7.49 times in 2020 to 8.54 times in 2024, while days sales in inventory decreased from 49 days to 43 days. This indicates that Hapseng was able to sell and replenish its inventory more efficiently over time. As a food manufacturing company, efficient inventory management is important because products have limited shelf life. Faster inventory movement helps reduce storage costs, improves cash flow, and minimize the risk of obsolete inventory. Therefore, inventory management can be considered one of the company's financial strengths. Next, we analyze receivables management. The receivables turnover ratio declined to 7.98 times in 2022 before recovering to 9.06 times in 2024. At the same time, days sales in receivables increased from 35 days to 40 days overall. This suggests that the company experienced some difficulties in collecting customer payments, particularly during 2022. Although collection efficiency improved in the later years, receivables management remains an area that requires continual monitoring to ensure healthy cash flow and effective credit control. Moving on to net working capital turnover, the ratio fluctuated between 4.04 times and 5.10 times over the period. This indicates that Hapseng maintained sufficient working capital to support its operations. However, the projections suggest that the company has not consistently optimized the use of working capital to generate revenue, while the improvement to 4.92 times in 2024 is encouraging. Management can still further improve efficiency by managing inventory and receivables more efficiently.
Next, I will present the fixed asset turnover ratio of the company from 2020 to 2024. As shown in the table, the ratio increased overall from 3.90 times in 2020 to 4.33 times in 2024, with the highest value of the 4.46 times recorded in 2023. This upward trend indicates that the company has become more efficient in utilizing its fixed assets such as production facilities and equipment to generate sales revenue. Although there was a slight decrease from 4.46 times in 2023 to 4.33 times in 2024, the ratio remained higher than previous years, suggesting that the company's asset utilization is still strong. Overall, the improvement in the fixed asset turnover ratio reflects better operational efficiency and demonstrates the company's ability to generate more revenue from its investment in fixed assets. Next, I will present the total asset turnover ratio of the company from 2020 to 2024. Based on the data, the ratio increased steadily from 1.43 times in 2020 to 1.57 times in 2024. While the increase may seem gradual, it reflects a positive trend in the company's overall asset efficiency. The ratio remained at 1.43 times in 2020 and 2021, increased to 1.50 times in 2020 and 2023, and reached its highest level of 1.57 times in 2024. This improvement indicates that the company was able to generate more sales from every ringgit invested in its total assets. In other words, the company utilized its assets more effectively to support the revenue generation. Overall, the increasing total asset turnover ratio demonstrates stronger operational performance, improved asset utilization, and supports the company's sustainable business growth.
Hello everyone, I am Uzi. For our group presentation, I am responsible for the leverage ratio section, which include the introduction to leverage ratio, total debt ratio, debt to equity ratio, equity multipliers, and finally, I will deliver the overall conclusion and recommendation. As an introduction, leverage ratio are essential because they show how much a company rely on debt. By comparing debt to total asset and equity, we can evaluate the company's long-term financial stability from 2020 to 2024. Let's look at the first ratio, the total debt ratio. As we can see on the slide, this ratio dropped from 38.9% in 2020 to a record low of 32.03% in 2023. This indicates a process of deleveraging, where housing actively paid off its debt. Even with a slight increase to 34.76% in 2024, the trend remained very healthy. This ensures stronger solvency and a stable capital structure. Ultimately, this low dependence on borrowing reduced the probability of default and improved our long-term financial stability. Next, the debt to equity ratio. As highlighted on the slide, this ratio consistently stays well below 1.0, ending at 0.53 times in 2024. This proves that our equity financing is much higher than that. This conservative approach provides a massive margin of safety for creditors and protect housing from being exposed to rising interest rate or credit restriction. Then, we have the equity multipliers, which declined from 1.64 times to 1.53 times. This proves the company is not over-leveraged. Instead of excessive borrowing, it shows that the most assets are financed using shareholder equities. By successfully utilizing its own internal strength and capital, this lower leverage position helps reduce financial risk and strengthen overall financial stability. That's all for my part. Now I will pass the floor to the next presenter.
I am Tan Sing Ning. My individual contribution was analyzing the leverage ratios, which is long-term debt ratio, high interest earn ratio, and cash coverage ratio. I also handle the video editing by combining all our members' recording into this video presentation. Starting with our long-term debt ratio, the drop from 5.63% in 2020 to 4.58% in 2024 proved the company maintains a low proportion of long-term debt. This highly disciplined strategy protects the company from structural financial risks. Next, our time interest earn ratio highlights immense operational strength, peaking at 2,954 times in 2020 and over 3,260 times in 2023. Because earning outpaced our interest obligation by thousands of times, our default rate is virtually non-existent. Finally, our cash coverage ratio peaks at 3,568 times in 2023 and holds at 2,807 times in 2024. This confirms the company can service all interest expense entirely through internal cash flow, eliminating any dependence on external debt.
Hi, my name is Dan Ivan and I will be proposing regarding the profitability ratio. So the first ratio is our gross profit margin. As you can see from the table, our gross profit margin decreased from year 2020 to year 2022 and increased to year 2024. So this gross profit margin proves that our company Housing Berhad core product remains a fundamentally profitability by maintaining a margin above 24%. So this proves that our company has effective cost management and also strategic pricing adjustment, which successfully stabilized the profitability of his company upwards. So the next ratio is our profit margin. So the net profitability actually did experience an aggressive turnaround, which compounding gains over 2 consecutive years to surge by a total of 6.37%. So this profit margin actually did prove that Housing Berhad successfully managed its indirect costs such as administrative expense, marketing and tax expense to stay continually profitable. So the high record of 14.57% of profit margin proves that our business is now more efficient at keeping costs lower than how it was before. So the next ratio is the return of assets. As you can see from the table, our ROA dropped until a low point of 12.25%, which shows that our new acquired assets or all of the existing investments actually weren't yielding optimal profits at first. And so to continue, the ROA actually demonstrates a solid corporate foundation of Housing Berhad where all of the assets actually are rarely left idle or unutilized. So the aggressive upwards actually, this signals our investors and also management that our business has actually unlocked excellent operational leverage. So we encourage all of the investors to invest in our company, Housing Berhad. So the last ratio is our return on equity. The declining of our ROE actually proves that our profit generation did not actually keep pace with our equity growth, and also our overhead costs actually temporarily squeezed our net earning. And the dramatic rebound to 35.17% of ROE confirms that there are strategic improvement in our core profit margins. So an ROE exceeding 35% actually signals that our Housing Berhad robust financial health, which makes the company exceptionally attractive to all of the potential investors and also equity stakeholders.
Moving to our conclusion, let's look at the strengths and weaknesses shown on the slide. Housing's primary financial strength lies in its healthy short-term liquidity, with a current ratio of 2.10 times. This is supported by high management efficiency seen in the inventory turnover of 8.54 times and a remarkable profitability surge with an ROE of 35.17%. However, we must manage certain risks. These include inconsistent receivable management and a high sensitivity to global commodity price. We also note constant pressure on increasing operating expense, which could impact future margin. Finally, for our recommendation, for investors, Housing offers a low-risk defensive profile and a secure yield, consistently paying out 60% of net profit. For management, we recommend 2 key actions. First, improve credit control procedures to stabilize cash collection. Second, pursue capital expansion. By utilizing its strong cash reserve for expansion, the company can better offset rising costs and sustain long-term growth. That's all for our presentation. Thank you for your attention.